Hi again. I had a client call me recently, and I realized by the time we were done with the conversation and looking at options that this was going to make a good topic for a video. This particular client had an account they were very nervous about listening too much to the news and wanted to take the money not necessarily out and get taxed on the whole thing. This was an IRA, but they wanted to take all the risk out of the account and put it in something safe like a money market or cash or a CD. This was an account that was designed to last several years. So that doesn't sound terrible, does it? With someone trying to take a lot of risk out of the portfolio, but they were about to blow up their plan. Now, as much as I can't predict how well something's going to do, if it's in the market or in a blend of different things in the stock and bond market and cash and domestic and overseas. So in other words, a diversified portfolio, not all eggs in one basket, which is the general rule for long-term investing, to be diversified. That history has shown us that a diversified portfolio in the past has outperformed an ultra-conservative portfolio over time significantly. Again, no guarantee, but it's been pretty consistent historically. In fact, I did tell this client if they did move to something ultra-conservative like cash or a CD, they were actually guaranteeing to predictably lose purchasing power in a very safe way, and also most likely going to run out of money many years sooner by doing it that way. It would be predictable, but not the kind of prediction that they were hoping for. So let's look at two situations. One account, let's just use $100,000, make the math rather simple. One account made 7% a year on average, and they needed $5,000 a year. The other account, they wanted no risk, so they decided to put it into something that made 3% a year, ultra conservative, and still needed to take out that $5,000 every year. On top of that, we've got 3% inflation, so that $5,000 is going to go up every year. Let's see the results. Now, to be clear, these are both hypothetical. This first illustration shows an investment with $100,000, taking $5,000 out a year, or $600 a month, increasing 3% with inflation every year, and averaging a 7% return over time. This particular plan lasted a little bit over 20 years. In the second scenario, same starting amount, $100,000, same inflation rate, 3%, same withdrawal rate, $600 a month or $5,000 a year, but this particular investment made 3% a year, and now we're lasting about 14 years for the same amount of starting money. Now, if you noticed, for the one account, I mentioned that it averaged 7%. It averaged 7% over time. So if that was an account in the markets, whether there's stock or bond market, it would be higher in some years. It would have been higher in some years. It would have been lower in others. But that's what long-term investing is all about. While it cannot be guaranteed, history does show that past accounts that have been in the markets have, on average, done better than an ultra-conservative account. A lot of it does have to do with how much risk you're willing to take and how uncomfortable you're going to be to the point where you might make a bad decision. If you are in that camp, ultra-conservative, you won't sleep at night, then the clear answer for me as a planner is you need to put more money in the account. You need to wait later before you can retire as you build more money into that account, because if you don't want to take risk, the money's got to come from somewhere. If it's not working for you, then you got to work for it.